The nature of the stock market that we're in is that it's very long upward swings and then corrections that are brief and free fall panics that we see. Sometimes they've been only 6%, they come really quickly, and sometimes they have been larger, where we saw 35%, 24% the last couple that we've seen in there. So that means it makes a lot of sense to expect that we're going to get some really sizable movement to the downside once the selling starts to come in. Let's take a look here as we switch over from that gold chart right over there and the gold daily chart right over here to the SPY. So we're looking here at, that's not the weekly, we want the weekly chart right over here of the SPY. And we could see that big upside move, the great megaphone. And you'll notice all those yellow periods. Those are all the areas where we got into the final weeks of the cyclical pattern. That's like right in here and right here, right here, right here. All of those, as these nest, it brings you declining or corrective phases. And like I told you, as I just grab these last few cycles right in here, the nature of this market has been long waves on the upside and brief waves to the downside. 4 weeks down, 4 weeks down, those were both over 6%. This one was 35% right over here in the panic. This was 10.8% right over here, so this was last March. And this one right over here was down into September. And this declining period here was about 21 days. This was about 15 days right here. So that means, it makes sense that this will be 15 or 20 days in the downside and be somewhere over 6% and more likely somewhere in the 10% area. I have two different scenarios in here. Well, let's just say it's a really bullish condition and you get the decline here to about 6%. Well, that takes you down to about 360.50 that you can see right there. Let me just grab this and move it away so you can see that 6% right there. And right over here, just get a little closer look there. This is a 10% move down here. This is the major 23.6% fib. I want to note that all of these supports have been rising. Every time we make a new high here, it pulls the supports up. And we're always adjusting that because the market's telling us to do so. So here's that period right in here, some 15 to 20 days that we've been talking about for weeks and weeks, saying that this risk really comes in end of January in through the beginning of March. And you can see this cycle's nesting down over here that brings those declines as it did right over here. And we're about getting into that. Note this fib extension area right over here. That was that 38.60 level that we got on the market. It's 385 right over here on the SPY. And 38.60 approximately on the SPX. So we're apt to that area. Is it going to get up here to 391 before it, or 390 before it then comes down? Well, we can't be sure about that, but we can be pretty sure that if it follows the same ideal patterns that it has all through these years that you see here, that there is a period of risk coming down here. The question is it going to be more like 6% and then get the move up here to test or make new highs, or is it going to be down here of 10% and then get up here and maybe fall a little short of the highs? Or is it going to be some crazy panic down here to the major 32, which is 38%, which is 17% decline, and then it won't get anywhere near the highs if it does that. So that's really what we're looking at in here. It's probably going to be somewhere in here where the market corrects because there is so much buying based on the prospective stimulus that is coming from the government. Of course, if the bond market has a fit, which it could possibly do that, and interest rates spike up based on that, well, that could hurt the stock market significantly. So a lot about all of what the influences are out there, and certainly a lot about just the fact that it's normal to have these fluctuations. And all we're talking about now is a normal fluctuation as we look at this. So we're getting into that time frame, and it is suggestive that there will be this corrective period in here, and the time is basically right now. It is important, I think, that if you go and watch our Future Speak show that we did on Wednesday, I show a very, very important base building period on the VIX. And that normally when that happens, you end up getting a move up in the VIX that is about it doubles from the point of its low. So right now we made a low around 20. The VIX could get to 40 in this decline in here. But if you want to see that chart, you're going to have to either go to FutureSpeak and watch it, or if you're a level 4 member, you can ask me about it. So that's it. I mean, this is the period in here where the risks are rising. And here on Friday, with the market just kind of sloppy a little bit, it's obviously not the time yet. The momentum conditions in here are very strong, as you see right over here with this momentum indicator having been moving up. And on our daily charts, we have the same thing with very, very strong momentum indicators. So the deterioration is going to need to happen to set it up. And so far, we don't see any of that. And if you are a member and you saw our short-term charts, the cycle structures that you see in there are still quite positive. So nothing is happening yet to show us this correction is starting. And all we are doing now is anticipating the normal flow, the heartbeat of the market. The rhythms that you see right over here are setting up what should be a normal correction starting pretty soon. That is a look at the spiders, the ETF. And again, if you want to learn about this analysis, go to our website, askSlim.com, to the workshops, and learn about cycle analysis.